Hey everyone, welcome back. Mark Rusin here, back for another video as we continue our journey to building wealth together. It has been a wild ride in the stock market the past 2 weeks as we have seen the major indexes under intense pressure. Over the past 2 weeks alone, the S&P 500 has retreated 3%, with the NASDAQ down over 5% during that same time span. With that in mind, I hope you have some cash set aside because in today's video, I'm going to be giving you 3 top dividend stocks to buy in the month of December. If this sounds intriguing to you, you have to check out today's video. Let's get started. Before we dive into the content, as always, please know that everything discussed in this video is for educational and informational purposes only, as I am not a financial advisor. Also, I want to mention a special promotion that M1 Finance is running right now for a limited time. Anyone that starts a new account at M1 Finance and funds $100 will receive $50 free into their account. Click the link below that I'll put down there in the description to get started. Also, grab yourself some free Bitcoin with my link down below to BlockFi. I keep all of my Bitcoin and Ethereum at BlockFi, earning interest every single month. All right, let's jump into the video. Dividend investing is one of my favorite types of investing as I love passive income. You can do this in a multitude of ways. You can invest in dividend stocks, individual stocks, or you can invest in dividend ETFs, which I recently did a video on, my top 4 dividend ETFs, and you should check that out as I'll put that link right up here and in the description down below. But in all seriousness, dividend investing is equivalent to earning income while you sleep. It is the best form of passive income. I have a personal goal of earning over $100,000 in annual dividend income, and I hope to log that journey here on YouTube, and I hope you will join me along the way as we invest in dividend stocks together. If you are pumped to hear my top 3 dividend stocks to buy in the month of December, do me a huge favor and hit that thumbs up button, as that'll be huge for the growth of our channel moving forward, and it costs you nothing to do. Okay. Let's get started with the first dividend stock to buy in the month of December, and that is Lockheed Martin, stock ticker LMT. Lockheed Martin is the world's largest defense contractor. The company currently sports a market cap of $92 billion. On the year in which the S&P 500 is up over 20%, shares of Lockheed Martin are actually down 6%, but over the past 3 months, shares of Lockheed have been under intense pressure, falling nearly 15%. The stock itself has been stuck in a rut for much of the past year, even though the company continues to accumulate multi-million or billion-dollar defense contract continuously, racking them up. Over the past 5 years, revenues of Lockheed Martin have grown at a rate of nearly double-digit percentage, which has led to 19 consecutive years of dividend growth. Currently, the company pays a dividend yield of 3.4%, with a 5-year dividend growth rate of 9.4%. The dividend has a very safe payout ratio of 42%, which are all solid dividend metrics when you're looking at a dividend-paying stock. When you think of a business like Lockheed Martin, regardless of the political party that is in power, the programs and the systems that they build are always in need. Whether it's the popular F-35 fighter jets or even the Sikorsky choppers are both 2 of the popular programs or products that are built by Lockheed Martin. As I mentioned a second ago, shares of Lockheed Martin have really gone nowhere over the past year, and the current valuation sports that, having a forward price to earnings ratio of 12.6. When you compare that to their 5-year average of 17 times, you can see that shares of Lockheed Martin are trading at a very undervalued level right now. Part of this pressure is warranted based on the Q3 earnings that Lockheed just came out with, in which management made some comments regarding slowing growth in 2022, which the reason behind that is due to the fact the company has an array of different programs that they will be building and putting into production here in the next few years, which will ramp up growth between the years 2023 and 2026 for these massive contracts that they have accumulated and are now putting into fruition. So you'll get slowing growth in 2022, which has kind of scared investors away a little bit, but that growth will continue to ramp back up in 2023 and beyond. So for those patient investors out there that are willing to collect that 3% dividend and know that you can start accumulating shares at a fair valuation, or really an undervalued valuation compared to recent history, Lockheed Martin could be a great play right now. Analysts currently have an average price target for Lockheed Martin of $382.50, with a target high, or an analyst high, of $430. So for the patient investor that is willing to wait, this could be a great spot to start adding shares of Lockheed Martin. So take a look. The second dividend stock to buy in the month of December does not really need much of an introduction, as they have been around since the year 1886 and is a consumer giant. This is none other than Johnson & Johnson, stock ticker J&J. You most likely have at least one, if not a dozen, different J&J products in your house right now. If you think about it, some of the common consumer products that J&J has includes Tylenol, Motrin, Zyrtec, Benadryl, Neutrogena, Aveeno, Listerine, Band-Aid, and Neosporin, just to name a few. J&J operates in three segments. You have your consumer products, your medical device sales, as well as your pharmaceutical arm. Just this past month, J&J announced that the company would be splitting into two separate companies. The consumer products would be its own company, and the medical devices combined with the pharmaceutical arm will be the traditional Johnson & Johnson company. Shares of Johnson & Johnson currently trade at a market cap of $428 billion. Shares of Johnson & Johnson have also been under a little bit of pressure these past few months, as the stock has retracted 10% over that time span. Being a mature company like Johnson & Johnson is, you're not going to get the high swings in growth or a ton of volatility where you're going to miss earnings by a big margin. Mature companies operate in a very consistent basis, but at the same time, you have to understand that the growth is not going to be huge. The top line growth. Over the past 5 years, Johnson & Johnson has grown revenues an average of roughly 5% per year. Free cash flows continue to remain very strong, as Johnson & Johnson is a cash king. The company, speaking of kings, is also a dividend king, meaning they have paid a dividend for over 50 plus consecutive years. In fact, Johnson & Johnson has now paid an increased dividend every single year for 59 consecutive years. How's that for consistency when it comes to a dividend? Johnson & Johnson currently pays a dividend that yields 2.7%, and the company sports a very safe payout of roughly 40%, leaving plenty of room for management to continue raising that dividend for years to come. Johnson & Johnson has some iconic brands, some of which we just mentioned, and the splitting of these companies will be able to unlock shareholder value for both companies. However, the split is not expected to take place for another 18 to 24 months, according to management. As I just mentioned, shares have fallen over the past few months, which provides shareholders with a great opportunity to invest in a high-quality blue-chip dividend stock. And these opportunities don't come very often, so you have to take advantage when the opportunity exists. Shares of J&J currently trade at a forward price-to-earnings ratio of 16 times compared to their 5-year average of 17.8 times. So you can see a little discount implying that the shares are undervalued. And like I had mentioned, shares of a giant like Johnson & Johnson do not go on sale very often, and they do not last very often as well. Analysts currently have an average price target of $195 on shares of J&J, which implies roughly 20% upside from current levels. So definitely take a look at shares of J&J to see if these fit your needs in your dividend portfolio this month. The third dividend stock to buy in the month of December comes from the REIT sector, and it is one of my favorite REITs. It is STOR Capital, stock ticker STOR. STOR Capital is a retail REIT, and for those of you unfamiliar with the word or the term REIT, REIT stands for Real Estate Investment Trust. Think of it as a landlord owning a portfolio of different properties. In the case of STOR Capital, they are a retail REIT, meaning they own properties in which they lease out to retail tenants. And before we get into the tenants specifically, I'll show you the top 10, a few of which you may know. Let me first explain a little bit about REITs so you have a better understanding. As I had already mentioned, STOR Capital is a retail REIT, but going a little bit further, they are what is known as a triple net lease REIT, which is my favorite type of REIT to invest in. A triple net lease REIT passes landlord costs over to the tenant. It is shared amongst all the tenants that are leasing that particular building. Think of property taxes. When you own a building, you get a property tax bill. Well, as this landlord in a triple net lease REIT, this landlord, like STOR Capital, passes those costs on to the tenants. Think of insurance. You usually, as a landlord, have to cover the insurance on your building. Not when you're a triple net lease REIT. You will pass those on to the tenants. How about maintenance costs? Same thing, passing those on to the tenants. So really you sit back and collect your dividend check. Another great thing about STOR Capital is the term of their leases. They have long-term leases that have built-in escalators, meaning each and every year the lease agreement has these rents step up, which is connected to a market value or even a fixed value of maybe 2 or 3% to ensure that the company continues to, one, stay up with revenues by increasing those, but also connected to market values. Okay, so now hopefully you have a better understanding on what a triple net lease REIT is. Next, let's take a look at some of STOR Capital's top tenants. STOR Capital has a very diversified portfolio. In fact, none of their tenants equate to more than 3.1% of total base rent for the entire company. Some names that at least I'm familiar with when looking at this list is Ashley Furniture, Camping World, Bass Pro Shops, and AMC Theater. So we have established that the company is a retail REIT. They focus on primarily retail properties. We've also looked into them being a triple net lease REIT, which hopefully you have a better idea now. And we've also seen that they have a very diversified portfolio, meaning they're not dependent on one major tenant. They have a very diverse group of tenants. And next, we have the backing of one of the greatest investors, if not the greatest investor of all time, in Warren Buffett. Warren Buffett and company have made multiple purchases of STOR Capital in recent years. How is that for stamp of approval? STOR Capital currently has a market cap of $9.2 billion. The company continues to find ways to grow revenues over the years, both by the lease escalators that we saw and just spoke about with the rent checks increasing each and every year, but they also continue to add to their portfolio looking for high quality properties to buy each and every year. In terms of the dividend, STOR Capital currently pays a dividend yield of 4.5%, which is a very high quality yield to obtain for such a great company. They also have a payout ratio of roughly 80%. Which, hold on for a second, because you might be saying, whoa, Mark, that is a really high payout ratio. Now with REITs, to obtain REIT status, which will give you tax benefits, you must pay 90% of taxable income out to shareholders in the form of dividend. So all REITs that you look at are going to have a very high payout ratio. And things you want to look at with payout ratios, you don't want to be focused as much on EPS because EPS doesn't really matter in the REIT world. You want to look at what's called funds from operation, or FFO. Think of this like operating cash flow. So when you look at a payout ratio of 80%, that is a pretty high quality payout ratio for a REIT. Over the past 5 years, STOR Capital Management has increased the dividend an average of 6% per year. STOR Capital currently trades at a forward price to FFO of 17.5 times. Now, when you compare that to their 5-year average, you can see that the stock appears to be undervalued, as the 5-year average is 18.2 times. Now, a common REIT, or one of the most popular REITs that you may have heard of before, is Realty Income, stock ticker O. Realty Income is set up almost identical to the same way that STOR Capital is. Many people consider STOR a little brother to Realty Income. When looking at the valuation for a company or a REIT like Realty Income, they trade at a price to FFO of 20 times. So you can kind of see the valuation that STOR Capital can at least grow into or get near, showing that there's price valuation or multiple expansion for a company like STOR. Analysts currently have an average price target of $38.71, implying 14% upside from current levels. So definitely take a look at this REIT, as it is a high quality company that is run by a very strong and competent management team. Thank you so much for watching, and if you enjoyed the video, make sure you give us a big thumbs up, and also consider subscribing and ring that bell notification so you'll be notified anytime we drop a new video. There's also some great links down in the description below, as I alluded to in our intro. And with that being said, we will see you in the next video. Take care.